Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by my company, Bull Realty. For custom asset and occupancy solutions, visit bullrealty.com or give me a call. Today we're talking about the hotel industry. Please welcome my next guest, Warren Marr. He's U.S. Hospitality and Leisure Managing Director with PwC. Warren, thanks for joining us, sir.
Thanks for having me on the show, Michael.
Thank you, Warren. So what do you expect, to start us off with, what do you expect for 2019 performance in the hotel world?
Slowing overall demand growth. What we're hoping to see is a continued shift in total demand, skewing, though, more towards the business traveler versus the leisure guest, which historically has played a much more significant role in lodging's current recovery than in the previous ones. The latter half of 2018 showed this return of the business traveler occurring finally, but the question is whether we continue to see this resurgence into 2019. Growth in 2019 will likely come entirely from room rate versus occupancy. If things don't derail with the economy, room rates are expected to be higher because of this resurgence in the business traveler. Now, it's important to understand, Michael, that business travelers are not as sensitive to price as midweek leisure guests. So many major markets can see higher pricing as we move into 2019. So as we sit here today, economic indicators suggest continued growth in the U.S. lodging industry into 2019, given higher consumer spending supported by a rising in disposable income, employment, and household net worth. Overall, growth in the industry is expected to continue, but at a slightly slower pace than we've seen over the past several years. But, and there's always a but, and so here it is. In the U.S., the boost from fiscal stimulus that we've been experiencing last year is likely to start to fade, and higher interest rates may dampen consumer spending. And it's not just about top-line performance either. Labor costs are going up significantly in a number of major markets this year within the lodging sector. And places where we see labor dollars, which are the largest expense for a hotel, increasing faster than room rates or revenues, we can expect to see margin erosion. So the short answer is stay tuned.
Stay tuned. Well, it's interesting to see some rate growth because it seems like that's been a little slow to grow, but I guess with more business travelers, it's interesting to see. Well, let me ask you this, Warren. I mean, we've had some recent government shutdown that's going on as we're speaking here today. We have some turmoil in the stock market that we haven't seen in years. So has any of that changed your outlook kind of recently?
Well, yeah, to kind of recap, stock market volatility increased significantly during the fourth quarter of 2018. It didn't take much at all in the way of news to move the needle in one direction or the other. Now, the new Congress has the potential to have a meaningful impact one way or the other on lodging performance, depending upon its positioning out of the gate with the White House. In addition, we continue to monitor trade tensions, waning fiscal stimulus, and increasing interest rates, as well as growing inflation. The government shutdown has already had a significant impact on a small pocket of the U.S. lodging industry. That's really primarily hotels located within or immediately outside the gates of some of our most significant national parks, as well as hotels in our nation's capital that rely on business generated by the various parts of the federal government.
Okay. And of course, REITs own a lot of hotel hospitality properties. So what do you see for REIT performance, and what do you expect moving forward from REITs?
Well, with REITs, the short answer is it depends. Many public lodging REITs were net sellers last year. The REITs that focus on larger group-oriented properties started to see traction over the past 12 months as group business, which is group meetings business, strengthened. On the flip side, we're seeing quite a bit of activity in the non-traded REIT space, with buyers looking for new vintage, meaning younger properties that are select service properties, no food and beverage, where the name of the game in these types of assets is cash-on-cash returns versus residual value. I also think it's safe to say it wouldn't be surprising to see some further consolidation in the lodging REIT space over the next 12 months. It's been proven that scale matters, and there are a number of players out there today with complementary platforms.
Okay. And Warren, if we're looking at kind of indicators, let's say that I have a listener who's nervous about the economy, and you're looking at all the economic indicators that impact hotels, what would be an indicator that we might want to pay attention to?
Well, in the lodging sector, there are two things that precede a downturn in hotel performance here in the U.S. The first is new supply. So the industry chugs along, doing real well for a few years. Lenders open up the purse strings, and developers, well, they develop. Supply increases and then surpasses the level of demand growth, and then we see a downturn. In this cycle, we've seen a much more disciplined lending environment and do not see supply being the Achilles heel for the sector over the next couple of years. So that's a good thing. So sure, there are pockets or markets where we are seeing some overbuilding, but on a national level, supply appears to have been kept in check during this cycle. Now, there's a second thing that can cause a downturn, and that is an unprecedented or unforeseen event. The terrorist attacks of September 11, 2001, the collapse of the financial markets in September of 2008, both largely unforeseen by the majority of investors out there, and therefore something that we really can't predict.
Yeah, and one thing that we can predict, or I guess we can see, is trade wars and tariffs and discussions about immigrations and a wall. What impact do these factors have on the hotel industry?
Well, I'll put trade wars and tariffs into the same bucket here, and then we'll move and talk on to immigration. So for trade wars and the resultant tariffs, it's all about size, duration, and with who. Increased trade war tensions with China could eventually have an impact on inbound leisure travel to the U.S. from that region.
Yep.
Now, with significant growth of the middle class in China, overseas leisure travel is increasing significantly, and the U.S. has become a very big beneficiary of that. And by default, a boost has been seen in lodging demand in many of the gateway markets here in this country. In addition, if tariffs make purchases of goods from China more expensive for the U.S. consumer, that could impact that discretionary spend we were talking about, of which leisure trips are a part. And thus the hotel spend by these same consumers could be impacted negatively. Now on to immigration. Unemployment is at historical lows in this country, and many of the entry-level jobs in the lodging industry have historically been filled by unskilled labor, many of whom are immigrants. Many hotels are having a very difficult time right now finding people to fill these entry-level positions. And the answer isn't just about paying more. A hotel is a business, and the margins need to work. And that's something that is becoming increasingly of concern for the lodging sector, is the ability to find talent and keep it.
Yeah, it seems like a big issue for the industry. Is that labor part of it? What about lower gas prices? Does that help the hotel industry, or more people maybe traveling?
Well, lower gas prices, you would usually say helps. The question is, what happens if gas prices go up? And it depends. If you're a luxury resort in a major destination, there's probably not that much of an impact regardless of what happens to gas prices. If you're a mid-market hotel in a drive-to destination, maybe it's a little bit more important. It also has to do with your business mix. A hotel that caters primarily to the business traveler market is less likely to be impacted as one that caters mostly to tourist trade. Obviously, the price of a barrel of oil also translates into the price of jet fuel. And if that goes up enough for a long enough period of time that airlines hedging no longer shields it, and the price of an airline seat can be impacted and again trickle down to lodging performance.
So then the current prices that are, I guess, considered pretty low, what are we at, $50, $60 a barrel? is favorable and is helping the hotel industry now?
Yeah, it's helping it, and it's I guess what I'd say is it's not hurting it because we've had, those level of oil or gas prices for a while now here. And so that impact has kind of already been built into the models and forecasts that people have.
Yeah, well, I hope gas prices stay where they are, or I'd love them to even be lower. Well, Warren, what would you leave our audience with to think about related to the hotel industry?
Well, like office and multifamily, industrial and retail, hotels are one of the commercial real estate classes that you can invest in today. And when you drill down to the absolute basics for any type of commercial real estate, two of the most important metrics are vacancy, or in the case of hotels, occupancy levels, and then your rental rates. In an up market, everyone wants to own hotels because you get to change your rental rates daily. In a down market, no one wants to own hotels because you get to change your daily rates daily.
Yeah, so that mean, I guess, since you think we're going to have rate increases, then this is kind of a favorable market where people may want to acquire more hotels in 2019 than we've seen in 18.
Well, you're in a situation where people are really starting to get concerned about whether we're, how close to the peak are we right now.
Yeah.
And so there is money sitting on the sidelines right now, waiting to see what happens because while there is nothing that suggests there is going to be a market downturn in the sector, there's nothing to suggest we're going to see significant growth as well.
Yeah.
And so the real issue is we're at occupancy levels in the hotel industry that we haven't seen in almost 40 years, well over 30 years.
Yeah.
And so for all intents and purposes, we're close to capacity. It's the ability to start to drive that room rate, and that's the issue here. If you can do that, the flow-through on room rate is very significant to the bottom line of a hotel's performance.
Right. Keep labor prices down and no unforeseen events, right? Warren, thank you for joining us, sir.
Thanks again for having me, Michael.
And thank you for joining us around the world, around the country, whether you're watching us on YouTube or on iTunes or any of the podcast sites. We appreciate it. And we do like hearing from you. We like connecting with you. So please do that. We're on LinkedIn, we're on Facebook, and we're on Twitter. And you can find all those connections at commercialrealestateshow.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show.